Forbes just released a poll showing that 78% of Americans are dropping out of the housing market. And they're pulling out because interest rates have risen way too fast and way too high. And these sky-high rates are causing people to pull out of the market altogether or pause applying for mortgages as they wait for the housing market to cool or these crazy rates to start to drop again. This drop in demand is going to have a massive effect on the housing market, so you definitely want to stick around to the end of this video because some of the data and the trends we're seeing are absolutely wild. Also, please don't forget to take a split second to like the video and subscribe to my channel so you don't miss any more of these real estate updates. All right, now on to the video. Given what's been happening with interest rates over the past couple months, literally going from under 3% to now well above 5%, which is the fastest increase we've ever seen in history, the lending market is really taking a hit. We've probably seen this most notably in larger companies like Better.com, as they've had to have massive layoffs and firing people because the demand for these services is just not there anymore. And if you think about it, it makes a lot of sense, right? In 2020 and 2021, with interest rates at rock bottom levels that we've never seen interest rates this low before, people were getting mortgages and refinancing their homes for 3% or even under, probably rates that we might never see again in our lifetimes. And so now that most people have interest rates at 4% or under, now that interest rates are higher than that, there's not a lot of incentive for people to go out and refinance their home and pay more for their home than they would be currently. So really the only people getting new loans are people purchasing new homes or trading up right now. So the demand for these services is just way down. Now let's take a look back at the data that I mentioned earlier from Forbes, with the 78% of buyers dropping out of the market. So 42% of respondents would stop applying for a mortgage when rates exceed 4%. So again, this is what I'm talking about. As interest rates continue to climb, you can see just more and more people are going to drop out of this market and are just not interested in applying for a mortgage. It's a tough pill to swallow, honestly, when you're used to getting rates of 3 or 4%. Adding an extra percentage point to your rate is literally hundreds of dollars, if not thousands of dollars, that you're just paying to the bank each month. So it really limits the size of the home you can buy, assuming your income is relatively fixed. And then again, a similar story here. 1/3 of respondents won't consider a refinance at a 5% interest rate. So if you just keep going up here, so this is when asked what interest rate would stop you from getting a refinance. So 3% here, 4% at 5%. You know, the majority of Americans say that they wouldn't consider getting a refinance, leaving only 24% of the people saying at 6 or 7% they would consider a refinance. So again, this is really going to be painful, and we're probably going to see continued layoffs and potentially even, some banks and lenders closing and going bankrupt. And the housing market really operates off of the simple economic principles of supply and demand. Now, any of you economics nerds out there are probably rolling your eyes and definitely understand this, so I'm going to cover it just briefly and at a high level to help everybody be on the same page and know what's happening here in the market. So supply and demand dictate both the price and the quantity of the housing market. So if there is just average demand, but there is massive amounts of inventory on the market, think 2008 when the market crashed and there was foreclosures everywhere, all of a sudden supply just went through the roof. Then we saw a massive drop in prices because there wasn't a matching increase in demand. So demand stayed relatively constant and supply shot through the roof. So that made prices fall. And on the flip side, in 2021 and this year in 2022, if there is very little supply and skyrocketing demand, then you're going to see prices skyrocket. And this is obviously exactly what we saw over the past couple of years up until now. But really importantly, these dynamics are starting to change, which is why so many people are saying we're heading straight towards a market crash. And that might be a little bit of a doomsday scenario. I don't quite think we're heading into a massive crash like we saw in 2008, but I'm going to walk you through some of the data right now to show you why these dynamics are definitely shifting and we are going to see some sort of correction, prices falling, and in some markets, some significant crashing going on. So one of my favorite charts to look at to understand the demand side of the economics equation is to look at Redfin's Home Buyer Demand Index. So I took a look at this last week, and last week we were sitting right about here, and you can see it's continuing to decline. So what this chart is telling us here is that in 2022, demand since about April, which is when rates started to increase, you can see demand really just starting to fall off a cliff. And now the demand index is starting to get down to what we saw in 2020, which again is just a really monumental shift in the housing market. And while this chart is seasonally adjusted, remember that we are heading into the peaks of the housing market where demand should be the strongest. And you can see from 2022, demand was much higher back in the first quarter of the year than it is now. So it's kind of the opposite of what you would expect to see, similar to what you saw in 2020. The last somewhat normal year, you saw demand hovering around here, and then as the summer months came, after we came out of the initial scare, is demand pop back up again. And we're seeing the exact opposite happening. So like I mentioned before, demand is absolutely starting to soften, and that will have a significant impact on housing prices. So now that we've confirmed that demand is weakening, the logical conclusion based on the economics 101 that we just walked through is that we'll see prices start to fall. And that is actually exactly what we're seeing. So let's turn over to some Redfin data to show you what's happening there on the supply side. So probably the truest metric of what's happening in supply is looking at the number of active listings. So this data here from Realtor.com dives into that. You can see we have data spanning from 2017 all the way through today in 2022. And some interesting things happening in this chart. First of all, we can see that the active listing count here is still extremely low. So we were at about 400K through the first quarter. So we see this massive jump here where we're above even where we were at in 2021. And this is really the biggest change that we've seen here in the last 2 years. You can see starting from 2020, just a continuous decline and drop. There was a little bit of an uptick here in the summer season in 2021, but we've just seen continued declines where year over year we were always below. And this is the first time where we've seen a reversal of that trend. So I fully expect this to continue. And again, a lot of this is largely due, in my opinion, to the interest rates increasing. I think the second key point and takeaway from this graph is that we're still at historically low levels. So we're only just about at 500,000 active listings. And a more normal range over the past couple of years has been just over 1 million. So anywhere between 1.1 or 1.2 or even 1.3, depending on the season. So yes, it's true, inventory is increasing and we're seeing a greater supply of homes now than even at this time in 2021. And I definitely expect this trend to continue, but I think it's still gonna be a little bit of time until we get back up to this more normal, healthy average range of over 1 million listings active at any given time. And while we still have that massive gap that we need to close to get back to normal levels, what we are seeing is that newly listed homes are climbing very quickly, and we're starting to actually get up into a much more normal territory. So we have new listing homes of a little over 500,000 homes in May, which is very, very close to being in that normal range here. So I think it's a logical question to ask is, okay, if we're seeing homes being listed on the market at normal rates, why aren't we seeing inventory climb? And the answer to that is on this next graph here, which is days on the market. So homes are only on the market for about 31 days, which is record lows. So people are listing their home and they're selling on average within 31 days, which is absolutely crazy. And so this is the key number that we need to follow and track, because the number of homes being listed is about normal, but homes are being bought way too quickly. So once we start to see this number turn the corner and start to climb up again back to normal ranges, anywhere from 60 to 70 days on the market, that's when we're going to see those inventory levels climb. And honestly, I think that we are actually heading in that direction. With rates increasing so much, we're seeing that demand decrease. And so I fully expect here as we enter the summer months that we're going to start seeing these homes stay on the market for a lot longer, as people are just not willing to pay these prices. And speaking of prices, this chart here is the price reduced share. And again, really interesting changes that we're seeing here in the market. So in 2020, we saw really record lows of the number of homes on the market that had price reductions. Anywhere from 8% to 12%. What we see here in the late summer months is some seasonality, where as people are getting antsy to get their homes sold toward the end of the year before demand really drops in the winter months, people start to reduce the prices of their home, make sure that they get it off the market. We saw that similar trend in 2021, but we are seeing a much earlier change in that trend here in 2022. And again, I think it's just because people aren't willing to pay these prices anymore, obviously with rates so high. So again, I fully expect this to continue to climb here, maybe getting into these levels by the end of the year. And one really important thing to mention is that the housing market in the United States is definitely not uniform. So housing market trends in one region or one city or one state definitely do not look like the entirety of the United States. So we're looking at averages here. So what that means is there's definitely some markets that are way more at risk than others. And I actually did a video on the top overvalued housing markets. So I'm gonna leave a link right here. So if you're interested in which markets are most at risk of a bubble and a subsequent decline or market crash, click that link. But there's some interesting data here from realtor.com that I wanna get into. And that data takes this price reduced share and breaks it out into the top metros. So you can see where we're seeing the greatest amount of homes having reduced prices. So here you can see Austin at 18% of the homes are reducing their prices. Charlotte at 12%. Detroit, 12%. Here, Las Vegas, 20%, so the highest we've seen so far. 13% for Franklin, Tennessee. New Orleans at 14.5%. And I think the second biggest here is Phoenix, which is 17.5%. And then something in Washington and Sacramento. So again, these price reductions are impacting housing markets differently. And again, those housing markets that are most at risk are going to be those that saw the most dramatic increases in prices in 2020 and 2021, especially where you didn't see subsequent wage growth. So where we're seeing the greatest divergence of house prices from wage growth is where these housing markets are going to be most at risk of some sort of crash or collapse. So I know that we've walked through a bunch of charts and data. So to summarize a bit of where we stand here and what the data is showing us is that we are seeing a noticeable drop and weakening in demand. And we are starting to see the supply side ease up as well, where we're seeing sellers start to reduce the price on the homes. And this will probably flow into homes staying on the market a bit longer as we go into the summer. Now, if you have a second home or you're planning to sell your primary home and move into a rental for whatever reason, if you're moving cities, now is probably the last good time to do it before we see the market start to probably shift from being an extreme seller's market to starting to shift slowly and slowly over to being either more balanced or maybe even a buyer's market at some point. All right, guys, thank you so much for watching. Do me a huge favor and smash the subscribe button so that I know that you appreciated the content and so that you won't miss any more great stuff coming from me in the future in real estate as we track these trends and personal finance and investing. Thank you guys again, and I will see you in the next one.